Imagine a world where everyone decides to withdraw all their money from the bank on the same day. Picture this, a typical Tuesday morning, but instead of the usual hustle and bustle, there's an unprecedented rush. A rush to the banks, as every single person decides to empty their bank accounts. What could possibly lead to such an unthinkable scenario? A few factors may play a part here. Perhaps a sudden loss of trust in the banking system, or maybe a wave of economic instability sweeping across the globe, or even a widespread panic, triggered by an unforeseen event. These are all plausible catalysts for such a mass exodus from banks. This isn't just a wild hypothetical, it's a sobering exploration of our reliance on financial institutions and the trust we place in them. Now let's delve into what might trigger such a mass exodus from the banks. What could possibly provoke such a widespread and coordinated withdrawal, you might ask? Well, let's dive into a few potential triggers. Imagine an economic crisis on a global scale that shakes the very foundations of our financial system, or a loss of faith in the banking system due to unethical practices coming to light. Perhaps even a significant data breach exposing millions of customers' sensitive information. These events can rapidly erode trust in the banking system, leading people to question the safety of their hard-earned money. A sense of fear and uncertainty can spread like wildfire, causing people to panic. And in their haste, they might decide to withdraw all their money. In a world where trust is the currency that keeps the banking system functional, these factors can serve as a trigger for a mass withdrawal, setting off a chain of events that could have far-reaching implications. Now that you understand the triggers, let's examine the immediate fallout of such an event. The immediate aftermath of a mass withdrawal would be chaotic. Just picture this. Banks around the world overwhelmed, their infrastructures pushed to the brink. As every last cent is demanded, the banking system, once a symbol of stability, would crack under the pressure. The sheer volume of transactions would be a logistical nightmare. Banks are not designed to handle the entire population withdrawing their funds all at once. The systems in place would buckle, leading to delays, errors, and a whole lot of frustration. Cash would become a scarce commodity. There's a finite amount of physical currency in circulation, and it's nowhere near enough to cover everyone's savings. The demand would far outstrip the supply, leading to inevitable cash shortages. As the dust settles, we'd see the start of a domino effect. Financial markets would be in a state of panic. Investors, unsure of what to expect, would scramble to protect their assets. Stocks could plummet, bonds could take a hit, and the value of currencies could fluctuate wildly. The ripple effect would extend beyond the financial sector. Everyday life would be disrupted. People would struggle to pay for goods and services. Businesses might not be able to meet their financial obligations, and economic activity could grind to a halt. While the immediate consequences would be severe, the long-term effects would be even more profound. This hypothetical scenario serves as a stark reminder of our reliance on the banking system and the delicate balance that keeps it running smoothly. In the longer term, the effects of a mass withdrawal could be devastating. Picture the economy as a human body and the cash flow as its lifeblood, circulating and nourishing every part of it. When everyone decides to hoard cash, it's like the body suffering from a severe blood clot. The lifeblood of the economy stops circulating, leading to a harsh economic downturn. Businesses, big and small, that rely on loans for expansion and operations find themselves in a precarious situation. Unable to access funds, they are forced to cut back, lay off workers, or worse, close down. This domino effect trickles down to the average individuals, who now face unemployment and financial hardship. Meanwhile, consumers, fearful of the future, continue to hoard cash, creating a vicious cycle of economic stagnation. Furthermore, the banking system, the heart of this economic body, is under severe strain. Confidence in banks plummets, prompting fears of bank runs. This fear, if left unchecked, could lead to more people rushing to withdraw their money, thereby further destabilizing the system. And let's not forget the global implications. In a world so interconnected, a financial crisis in one country can send shockwaves globally, leading to widespread economic instability. In other words, this isn't just a local problem, it's a global catastrophe. In response to such a crisis, governments and institutions would have to take drastic measures. In the face of such a crisis, governments and financial institutions would need to act swiftly. The first order of business would undoubtedly be to stabilize the financial system. This could involve implementing emergency measures like temporary bank closures or restrictions on cash withdrawals, which, while drastic, could help to prevent a complete collapse. Simultaneously, there would likely be a push for regulatory reforms. After all, a crisis of this magnitude would force a re-evaluation of banking practices. The debate would be fierce, with some arguing for stricter regulations to prevent such a scenario from happening again, while others might advocate for more freedom in financial markets to allow for innovation and growth. But perhaps the most daunting task would be restoring public confidence in the banking system. This would require a Herculean effort from both government and financial institutions. Transparency would be key, as would a concerted effort to educate the public about the safety measures in place to protect their money. This could include public awareness campaigns, open forums for discussion, and enhanced customer service. However, the road to recovery would likely be long and fraught with challenges. Not only would there be logistical hurdles to overcome, but also deep-seated mistrust to address. After all, once the public's faith in a system is shattered, it's not easily mended. So what can we take away from this hypothetical scenario? The scenario of everyone emptying their bank accounts simultaneously is, of course, highly unlikely. Yet, exploring this hypothetical situation has led us through the potential cascade of events, from immediate chaos to long-term economic effects. It served as a stark reminder of the importance of trust and stability in our financial systems. As we move forward, let's not forget this fragility. Remember, the financial system is more fragile than it may appear, and diversification is a key strategy in managing risk.